Um, Today, I have the chance to be with Danielle Neziol, who's a VP at BMO GAM. I think GAM stands for Global Asset Management.
Yeah.
And we're going to talk about inflation, because inflation, sure, it makes the groceries more expensive, but also have an impact on our savings and also on our investments. So we're going to start now. If you want, Danielle, first, thank you so much for coming to Facebook with me. It's appreciated. And I think you have a disclaimer you want to show people that you're required to show. So I'll let you show the disclaimer.
Yes, thanks, Julien. I'm being at the bank. We have disclaimers always that we like to share before we get started. But I want to say it's awesome being here with you. It's awesome being here with Hard Bacon. I'm really excited for this Facebook Live, and thanks for everyone who's joining us. But before we get started, I just want to remind our whole audience and our viewers today, I'm not here to provide advice. I'm not here to provide investment recommendations. I'm just here to provide education. We're going to have a really interesting talk on inflation, why there's inflation, what is inflation, and how it impacts your investments. And then we can talk a little bit about ETFs and how you can use ETFs in your investment portfolio in a rising inflation environment. So we're going to get into that. And Julien, I just want to say, being at BMO Exchange Traded Funds, at BMO ETFs, it's been such a pleasure working with you and your firm at Hard Bacon, because you have
Thank you so much.
Yeah, you guys have a lot of the same mandates as us with, financial education and trying to connect with Canadian investors. So it's really, really great to be working with you. I know last week you did an event with Alain Desbiens. You guys did that in French. And I heard that you said you wanted to come down and open the stock market and ring the bell. It's one of your bucket list things.
Yeah, for sure.
So I thought maybe we'll have to get you to Toronto sometime to ring the bell. That would be really fun.
For sure, there's no bell in Montreal that I know of.
Although the picture on the screen here, we actually rang the bell in Montreal once at an Inside ETF conference. So there you go. It's been done in Montreal before.
Oh, cool. I didn't know that.
A remote one.
So perfect. So I'll start with my first question. So I know a lot of people are here to listen about investment, but just before to enter the subject, can you define inflation for us? What is inflation?
Sure. So I know everybody's been hearing about inflation a lot. It's being reported in the news. And of course, we're seeing it at the gas pumps. We're seeing it in the grocery stores. It's really affecting all of us. And I know from my perspective as an investor, I opened my first RSP in 2008. So I've actually personally never faced this kind of inflation. So I think it's really important for investors and younger investors to really understand what's going on and how this is impacting their investment portfolios. So inflation is essentially the rising cost of goods and services over time. And my kind of favorite example, Julien, is how my grandmother, love my grandmother, but every year since I've been a little girl, she gives me $100 on my birthday every year.
Okay. That's nice.
She's so nice. I love her. She's great. So, but that $100, Julien, that she gave me on my 10th birthday had so much more purchasing power than the $100 she gave me on my 30th birthday. And that's because every year things tend to get more expensive. The price of my coffee has gone from $2 to now it's $2.50. So that $100 is not going to be able to buy me as many goods and services today in 2022 as it did, over 20 years ago. So that's essentially what inflation is in a nutshell. Now, we hear a lot of terms. We hear this term CPI, Consumer Price Index, and this is what's being reported. Julien, you and the audience might hear this number. The last one reported in Canada is 6.8%. Well, what does that mean? It really means that the cost of goods and services in Canada has risen over the past year. So from April 2021 to April 2022 by 6.8%. This is a very, very high inflation rate When we look back over the last 10 or 20 years, the inflation in Canada has averaged about 2% a year. And in fact, it went negative in 2020 during COVID, when the economy shut down, gas prices plummeted, people were locked down. Inflation actually went negative for a very short amount of time then. So that's essentially what CPI is, what inflation is. And then I just want to give the viewers a sense of, well, why is there inflation right now? What's going on? And there's a lot going on. And that's why I think we're seeing inflation numbers like 6.8%. So we're seeing things like the Bank of Canada rising interest rates. They're rising interest rates to temper inflation, to try to cool inflation. But if you remember 2 years ago, and actually beyond that, interest rates were rock bottom, very, 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 very low. So a lot of Canadians were able to borrow a lot of money cheaply. And with that, there's more money in the system, and this causes prices to go up. I can think of no better example than the housing market. You know, it was very cheap to get a loan with interest rates so low. So there was many people buying houses, and then the cost of houses goes up. So that's kind of an example there. And then things like gas prices going up, supply chains have been disrupted around the world, which means we're paying more for goods. Everybody has jobs. So there is actually a labor shortage, and we're paying people more money to work. And then there's been stimulus. So if you remember, Julien, those CERB checks that had been sent out, a lot of money was pumped into the Canadian economy, and all this money, all of these factors push inflation numbers up.
Yeah, I recruited in 2021, and it was hard. People wanted more money, and they had their own condition. But like inflation is interesting because obviously the value of our money is going down. So what we want to do, it's kind of another incentive, because there's always an incentive to invest money for the long term, because it compounds, and you get better return than 0 or 1% or something that you could maybe get in a bank account. But now, like, your money is actually losing value, like you mentioned 6%. So as an investor, you want to go into assets that are also affected by inflation. So it could be equity, like companies, they sell stuff. So if they increase the price that they sell this stuff, then they end up not being too much affected. They are a little bit, because they have employees, and their business model might be a little affected, but much less. And then there's the other asset, let's say that you buy, we mentioned real estate. Obviously, if there's inflation, those things will go up as well. But for someone who wants to invest in an ETF, like, what are all the equity ETF or all the ETFs that invest in companies the same in terms of inflation protection, or there's certain ETF people should look at in order to?
Good question. So I know we're saying we're impacted in our spending on inflation, but you're absolutely right, Julien. We have to think about our savings too, and how inflation is affecting our savings. Because if you and I are facing a 6.8% inflation rate, if my investment portfolio is not making at least 6.8% this year, then I've actually lost the purchasing power of my money. You have to make that inflation hurdle to grow your asset base. So very important thing to highlight. Now, in terms of ETFs and how you can use these in an inflationary environment, we generally say that equities provide better inflation protection than fixed income. There's some reasons for this. So you made a good point about companies can often push forward the increasing cost of goods and services to consumers. So those types of companies tend to do better. Equities are more growth vehicles than fixed income. So they have potential to kind of beat that inflation hurdle every single year, whereas fixed income is more about stability, providing lower volatility, less risk in a portfolio, but doesn't give those larger gains like an equity side of the portfolio would. So it's something for investors to consider. And of course, at home, you have to decide your own objectives, your own investment time horizon, your risk profile before you know how much equity and how much fixed income you want in your portfolio. But equities generally do protect a little more against rising inflation than fixed income.
Thanks. And so like in terms of like, if you read about, you know, the modern portfolio theory, like you need to diversify, and especially across asset class. So like usually, you know, there in a portfolio you have like fixed income and then equities. Sometimes it's like Canadian equities, US equities, you know, emerging market, or and so on. So there's kind of a distribution. And as you get older, usually you're going to get more fixed income. And my question, fixed income right now in a high inflation environment looks like a way to kind of destroy value more than anything else. Even if it does reduce the risk of the portfolio, and actually, like a lot of people don't realize that actually managing a portfolio is managing risk more than anything, because if you reduce the risk, you know, to increase the return over the long term. But still, it's not attractive, especially as a young investor. I'm like, why would I invest in something that, you know, I do my calculus and I'll probably lose money on it? It's better than my savings account. And there are a lot of ETFs that do bonds. Is there like a way to have some kind of, you know, a part of your portfolio that, you know, behave like fixed income, but, you know, in a way that would be kind of protected against inflation, or less bad than the usual bond ETF?
Right. Okay. So I'll just start by saying, in this environment with rising inflation, what happens is the Bank of Canada or the Federal Reserve in the US, how they respond to pull inflation down is they start rising rates. And there is an inverse relationship between the price of a bond and rates. So as rates go up, the price of a bond goes down. That's just kind of finance 101 or economics 101. So we've actually seen, as interest rates are rising very quickly in response to rising inflation, we've seen fixed income have the worst returns that we've seen in, I think, like 30 years. Now, this is usually, fixed income is a very much more stable asset class, lower volatility, providing that protection that some investors need or require. But this, you know, Q1 and Q2 2022 has been a very unique environment for fixed income investments. Now, within fixed income, there are certain things investors can do to get creative to hedge against inflation. And one of those things is to consider inflation protected bonds. So there's two types. We call them TIPS bonds, and these come from the US. So they're Treasury Inflation Protected Securities. That's where TIPS comes from. And what these are bonds that the principal is protected against inflation. So we've actually seen TIPS bonds have been, I think, the only area of the fixed income market, or one of the only areas of the fixed income market this year, that have actually had slightly positive returns. Now, in Canada, it's very difficult, or in the US for that matter, it's very difficult for direct investors like yourself or I to buy bonds. They don't trade on the exchange. You have to go through a broker or an investment advisor. But with an ETF, this is one of the most beautiful things about using an ETF. You get access to these bonds in an ETF that trades on the exchange, and you can buy or sell at any time market hours are open.
So do you have like a TIPS ETF?
Exactly, we do. So at BMO, we have a TIPS ETF called ZTIP, ZTIP. And this trades on the exchange. So if you're a fixed income investor and you're thinking about, maybe I need to hedge away some inflation risk in my portfolio, you can go into your direct brokerage account. You can purchase a TIPS ETF like ZTIP. Now,
I have a question for you.
Yeah.
Like, since it's an American product, is there the foreign currency risk? What if, like, for some reason, and Canadian dollar, you know, become, you know, stronger? Like, is it hedged for foreign currency, or it's not?
So another great benefit for Canadian investors is that we offer currency options to them as well. So not only can you go into your investment portfolio, Julien, and decide, you know what, I want to get a little inflation hedging, I'm going to go buy a Z-tip or a TIPS ETF, but I also want to manage my currency and manage my currency risk. So we offer that ETF at BMO, at least our product is offered in 3 different currencies or 3 different currency options, I should say. So you can have it hedged. So this is ZTIP.F if you're looking for the ticker symbol. So we hedge away the currency exposure. ZTIP, that ticker is unhedged. So your return will also include the return of the US dollar relative to the Canadian dollar. And then some investors actually use US dollars frequently, and they have US dollar accounts. So we also offer ZTIP.U, which trades in US dollars, and the distribution comes to you in US dollars. So you have the 3 options.
So this one is useful for someone with a US brokerage account. It can be open in Canada, but then you don't pay the foreign conversion fee.
Exactly.
So that's good. The investors don't like fee. And the good thing about saving on fees is that there's no risk when you save on fees. So it increases return if you manage to pay less fees. Like a lot of people, especially in our audience, we did a survey. I think 28% or so. I don't have the specific figure, but it was quite high. About 28% of our audience had cryptocurrencies, and I remember, and it was making me angry. Not angry, but I kind of disagreed with this proposition. But a lot of people said, like the nominal, like national currencies. They're inflationist by design because most central banks aim for about 2% inflation, and Bitcoin is a limited supply forever, so it's not going to be an inflationist economy, and it's a great hedge. It's completely uncorrelated to market. So it's like, not that I knew what would happen. My thinking was, Bitcoin was created, in 2019, so Bitcoin never went through a downturn. Or an inflationist environment and so on. So I was like, I'm not sure if it's such an edge. Like, it's a very interesting technology for sure. First, I have 2 questions. First, is BMO is going to launch a Bitcoin or crypto ETF like we've seen other financial institutions in Canada do? And second, what do you think about crypto as an edge in general?
Okay, so the first question, we're not looking right now, Julianne, at listing a crypto ETF. There are a lot of crypto ETFs out there in Canada. And actually, if you didn't know, or if the audience didn't know, Canada was the first place that crypto assets were listed within an ETF. And it just goes to show you it's how fantastic an ETF is for investors, because it's bringing these hard to access asset classes, whether it's bonds or cryptocurrency. It's making them available to investors in their discount accounts. So that's been a really positive thing, I think, for the ETF environment. But crypto is still a very highly speculative asset class. We just don't know how it's going to react to certain market cycles, certain things, certain times. We just don't have the back test or all the data around it. And if you look at the returns in crypto over the past, I think 6 months, year to date, it's been quite negative. And we're actually seeing a lot of flows, a lot of investors pull their money out of crypto assets. In April, we call them the flows. So we look at, are people buying that ETF or selling that ETF? And when we say the flows have been negative, it means more people have been selling it than buying it. Yeah. So I think a lot of investors who got excited about it, last year when the ETF was listed, are maybe starting to reevaluate their investment portfolios and thinking, did I take on too much risk? Did I take on more risk than is right for me? And trying to rebalance or rejig their portfolios.
Yeah, makes sense. So is there, like, I know that ETF are interesting. Like, it started where you wanted to buy the whole economy, and in Canada it would be like TSX 60, and the US the S&P 500. But now there's like, you probably know the number of ETF in Canada or the US, but it's thousands probably. And I know now you can buy like certain industries and even teams and investment hypothesis. So like, are there industries in the economy where industries that are less affected by inflation. And there's something interesting about inflation I read a long time ago, and it was about the Coca-Cola company. And at their beginning, I don't know exactly what was the dates, but I think it was from the beginning of the century until the 50s. A Coca-Cola always cost 5 cents. And I might be wrong on the exact dates, but the story, it was over 50 years or something. And the reason it's not normal, because if we look, there was always some sort of inflation, sometimes, low, sometimes higher. And the problem is that they had all those machines where it would take 5 cents, but those machines were not designed to be modified. So basically they had them all over the United States, and the cost was just tremendous to replace all those machines. So they kind of, kept trying to decrease their cost. I think at some point they reduced it a little bit, the size of the bottle, but so basically they were in a they were not inflation. They were vulnerable to inflation. If there was an inflation crisis during those years, they would have a big trouble, because they have to sell their Coke for 5 cents. So obviously, I don't think there's much companies that have a distributing machine that cannot be modified today. But are there businesses or industries that react well to inflation, and other ones that like they're like Coke during those years, it's really hard for them to adjust their pricing?
I love that story. I learned something today, Julien. I didn't know that about Coke, and good thing they got their machines fixed, because I think there'd be a run on Coca-Cola if we were still getting at 5 cents a can now with the way inflation's going. But you're right. So, some companies are better at being able to push forward those increased costs than others. And then there are some sectors which generally in an inflationary environment can weather it better, or can do better in that environment than others. One of them, and I think this is no surprise, is the energy sector. As Canadians, especially, the energy sector is such a big part of our overall economy. We're pretty well aware of how well energy's been doing. It was the number one performing sector in 2021. It is still the number one performing sector in 2022. And a lot of that is because energy producers can increase energy costs on us. And if we've gone to fill up our gas tanks in the last few months, we can see how high those energy costs have gone. So energy is definitely one of those sectors that can weather an inflationary environment better than others. Another is commodities. So we think of things like gold. So gold has actually been a classic inflationary hedge for many, many years. We're seeing gold at about 1,800 an ounce right now. It's sort of hovering around that, but certainly much higher than the price of gold has been if we look back three to 5 years. Reits, so real estate investment trusts. So this is exposure to the real estate market. Reits are considered hard assets as well. So anytime you're looking at hard assets, this usually works in an inflationary environment.
Would commercial REIT be different than residential ones? Because like in the commercial lease business, like the lease you hear is like 20 years, 25. So I'm like, do they have the ability to raise price?
I'm not sure on the sub industries of the REITs and how the contracts work, but I do know in general those hard assets and owning those buildings for the long-term, long duration assets are generally better, and they usually lock in a lot of their debt at different or lower rates, right?
So, you're right, because the buildings themselves are increasing a lot in value, even if they have trouble increasing.
Correct.
So yeah,
and their financing costs are locked in at rates too. So that's just a few things to think about. And then so I will mention there are sector ETFs available for investors. So if an investor is thinking, I want to get tactical, I'd like to perhaps add a little bit of exposure to a specific sector like the energy sector or REITs to my portfolio to kind of take advantage of these economic tailwinds. Those ETFs are available. At BMO, we have ZRE, which is our REITs ETF. We have ZEO, which is our oil and gas or our energy ETF. So those are things investors can consider. But I will just mention one more thing too. Usually high quality blue chip companies will do well in an inflationary environment, or they'll do better than their peers. And this is because in an inflationary environment, we'll see central banks rising rates. So we talked about this. When rates go up, debt gets more expensive. So any company who has a lot of cash on their balance sheet, who can service any debt or any leverage, or who has low debt in general, those companies are going to come out on top as you see rates rise in reaction to rising inflation.
So basically looking for companies that have like a double or triple A credit rating because their cost of capital is lower.
Correct. So we call those high quality companies, and we have ETFs for that. We call them our quality ETFs. So we have a ticker ZUQ. ZGQ is our global quality. So that's something for investors to consider as well.
And I have a question for you. Like when I see a downturn, maybe I'm a little bit a contrarian. Like I hate paying too much, and sometimes being too cheap as an investor is bad too. But I like it. I see price going down. I feel it's like a sale, and the more it goes down, the more I feel it's attractive. One of the issue is that I wish I was sitting on $100 billion of cash like Warren Buffett, but I'm a regular person. My job is being a startup CEO, so it's not gigantic salaries, and I want to take advantage of the situation, and I'm wondering, like, usually the traditional way is to have part in cash, so it's ready to go if you see an opportunity. You invest, and I know that generally holding too much cash is stupid, because you don't know exactly if it's going down or up. We don't know exactly where we are in the cycle. It's just after we're going to see a nice curve and it's going, oh, we should have sold everything there and buy everything there, but nobody does that. But my question to you is, like, could we use, like, let's say that the cash part, like, does it make sense? Because you can sell, especially at the retail level, you can sell almost immediately. Like you were talking about, TIPS ETF or something. Do you think it makes sense for an investor to be like, okay, like I want to have some firepower, but I don't want to hold too much cash because of inflation, and also because I want a return. Would it make sense to hold like, let's say, like bond ETF or TIPS ETF, and then wait for the opportunity, you sell it and you buy? Or what do you see in general? Like, I'm not asking for a financial advice, just in general, like how do you manage cash in a portfolio? Because lots of at the institutional level, a lot of them hold cash.
Yeah.
And I just don't like holding cash.
Yeah, and I get that. We this is such a popular question, Juliana. So I have to turn around and say, as an investor, first you got to ask yourself, well, what are the goals of my investment portfolio? So cash is there because it offers liquidity and stability. That's what cash is used for. So you need to determine, how much liquidity do you need? Are you planning on buying a house in 6 months? Maybe you do need that cash liquid and ready to go to purchase your home. But maybe you're a long-term investor and you don't have any use for cash in the long term, in the next 10 to 15 years. So maybe you don't need that liquidity and stability. The fixed income portion of the portfolio, yes, it provides a little bit of income, a little boost on that, still giving you the lower volatility, still giving you that kind of stability. But again, cash and fixed income a little more exposed to rising inflation.
Yeah.
And then you dip your toe, or you move over the risk spectrum into equities. This is somewhere where there's much more growth opportunity. There is much more volatility. So you'd have to be able to ride out market dips and market sell-offs and be comfortable with that kind of risk. So I think investors first need to just determine that asset mix and what works for them before deciding how much cash or how little cash. Now, I wish, you say you're an entrepreneur, Julien. Imagine we could go into the business of crystal balls. Wouldn't we? We'd be billionaires. I wish we had a crystal ball. You can't time a market bottom. This is something we always talk about. So if you are thinking about timing the market, I think this can be very difficult. I work in asset management. I work with very, very highly skilled portfolio managers who have large teams of analysts and resources beyond resources to try to time the market, and even they get it wrong.
So, nobody knows.
Yeah.
Can make a prediction, and a lot of people do, and minority of them get it right, and it's probably luck. I mean, that's my opinion.
But here's the beauty of using an ETF. So if you're thinking, okay, looking at what's happened in markets, equity markets is sold off about 20%. I think the S&P 500 is down almost 20% or 18 to 20% year to date. If you're a long-term equity investor and you're thinking, I'd like to deploy some capital and get into markets, and you're okay if the market continues to drop for the short term, if that's something you're comfortable with, you can look to an ETF, because an ETF is diversified. So that diversification means you're holding a basket of, for example, if you buy an S&P 500 ETF like ZSP 500 of the largest US equities, that will be less volatile than if you were to go out and buy a single stock. So something like an ETF, especially if you're thinking of getting into equities at this time, will provide that diversification, which is a really nice benefit for investors.
Yeah, for sure. So, I mean, unless the audience have a question, that's about the time we planned for this interview. So thank you so much, Danielle, for your time. It was really interesting talking to you, and I learned a couple things today. So thank you for that. And did you have a last word?
No, I think that's it. Thanks so much for having me. It's always great to talk about this, and I hope all our listeners that tuned in learned something. And if you want to learn more, we have a site, etfmarketinsights.com. We have a lot of resources on there. So if you're hungry for more information, check that site out.